So Marissa, what compelled you to go to the dark side of startup life?
Um, if anybody here has been in public accounting, they would know, and I need to say nothing else. I did it for far too long. The tax world is very specific. It has very specific demands of your time, very stable, which is what drew me to it. I will always have a job with a background in tax, which is great. But I feel like I realized I was more of a social person, and you're stuck in a cubicle for 60 hours mandatory every week, 6 months out of the year. Being someone who's risk averse, a startup was very interesting for me to consider.
It's a
Uh,
huge jump for sure.
Huge jump. Specifically, I repositioned into sales. So I went from tax accountant to a sales role here at Collective, and it was a complete culture shift, fresh out of COVID, so fully remote,
Oh man,
all the new things, but it's been over 3 years and I'm still here, which is like a lifetime in startup land. So I think that was the right call.
amazing, amazing, amazing. Hello everyone. We're just going to give everyone a few minutes to trickle in here, and then we'll start probably at about 1:03, maybe another minute.
Ebony in the chat, I see you. Good afternoon. Hello, welcome. This is recorded, and I believe a recording will be sent out.
All righty. Well, what do we think? We're good to go. Yeah, we've got over 110 people. It's feeling the vibes.
We're feeling it. Good afternoon,
Yeah.
everybody.
Let's do it. All righty. All righty. Well, welcome everybody. I'm sure we'll have a few others trickle in, but thank you all so much for joining us today, showing up on time. My name is Michael Rangel, founder of Novo, and I'm genuinely excited to be here with you all today. One of my favorite things about building Novo over the last 9 years has been getting to know our small business owners, hearing your stories, your challenges, and learning from you just as much as I hope you've learned from us. And actually, pretty recently, we just had one of these surprising experiences. And it was with one of our earliest Novo customers who has been with us since 2018. That's like a lifetime ago. He was recently in Miami, so my wife and I invited him over to our home. Usually, when I meet up with our customers, it's to learn about them and share any advice I can. But this time, it was different. He was the one giving me advice on how to be a new father. That moment really stuck with me because it reminded me how much of a two-way street this journey is, the two-way street of being a business owner, running your own shop. And that's exactly what our partner webinar series is all about, learning from each other and bringing in industry leaders to provide insights and practical strategies to help you run your business more efficiently. Novo hosts events like this every week because we know that being self-employed comes with a unique set of challenges, and we want to make sure you have the right resources to navigate them. If you'd like to stay in the loop for future sessions, we'll drop a link in the chat where you can sign up for notifications so you never miss an opportunity to level up your business. Now, let's dive into today's topic: taxes. Ah, I
Most
don't have to tell you. Go for it, Chris.
No, just the most exciting topic ever. Go for it.
Boom. It's what brings us all here, and what empowers us to commiserate together. So, with that, just aside, right? I don't have to tell you that tax season for the self-employed can feel like an endless maze of deadlines, forms, rules that make literally no sense. And let's also be honest, nobody starts a business because they love filing taxes. Sorry, Marissa. Um, but getting it right can mean the difference between keeping more of what you earn right? Or getting hit with unexpected penalties. So I have a quick question for you all. With your response, if you just drop something quickly in the chat, type a few words, drop an emoji, whatever you think is appropriate. How many of you have ever waited until the last minute to sort out your taxes? Drop something in the chat. Let us know how you feel. And because of that, right, how many of you probably didn't file correctly, right? Or worse, you probably left some hard-earned money on the table. Yeah, we've all been there, including myself. If I wasn't talking, I would have put something in that chat. So don't feel like you're alone. We're all culprits. And that's exactly why we're here today, because tax season for the self-employed can be needlessly complicated, but we believe it doesn't have to be, which brings me to the Collective, an all-in-one financial platform designed specifically for self-employed entrepreneurs. I recently actually caught up with Collective's founder at a conference, and I was reminded of why I love what they stand for: helping solopreneurs simplify taxes, business formation, and financial management in a way that actually works for them. It's completely aligned with what we started Novo to be all about as well. And today, I'm thrilled to introduce my partner in crime, Marissa Achinzar, who knows this world inside and out. Before leading growth and sales enablement at Collective, Marissa spent 10 years as a public accountant. God bless you, Marissa. I don't know how anyone signs up for that kind of work for so long, but we're all really, really lucky she did, because she's helped countless business owners navigate the tax system and keep more of what they earn. But beyond her professional expertise, this is also personal for her. Yesterday, when I connected with her, I learned that her own father is a small business owner, and she's been helping him with his taxes for years. In fact, she even got him signed up for Collective so that she didn't have to help as much anymore. She's here to break it all down for you, and more importantly, she's here to answer your questions. Throughout today's session, if you have any questions that are top of mind, please post them in the Q&A on your Zoom screen, and our community manager, Bailey, who is also on today's call, will be collecting them for Marissa to answer at the end of today's session. With that, Marissa, take it away. Thank you so much, and thank you everyone for coming.
Thank you so much, Michael. Everybody who participated in that very honest chat question, I am with you. I file my taxes late because I'm a tax accountant, and everybody else comes first before the tax accountant. So I'm with you. Very human. You're not alone. Today, I'm going to share some more detail about what Collective does specifically. Michael gave a great overview. We're here to support solopreneurs at any capacity, education. They're a fit for Collective, take on a suite of services to make being a solopreneur easier. We'll go into some high-level education. We're not going to spend too much time in presentation mode, and we're going to pivot over to Q&A. So no bad questions, and Bailey will help us monitor that, but I'm going to dive into this presentation. At any point in the presentation, there are these QR codes. Feel free to scan. It's a link to our team, so you can book time to continue the conversation. And these will be on the deck throughout. So again, we're going to start with some key deadlines that are coming up. Tax season has already started, so we're going to touch on those. Some high-level differences between state and federal filing obligations. Super high-level tax saving strategies and tips to lower your tax burden. And then we're going to pivot over to the discussion. So Collective, again, I'm going to reiterate what Michael said. We are an all-in-one solution specifically for entrepreneurs, even further businesses of one. And I'll tell you what that means, but Collective is a digital service, bundle of different services that would otherwise be pieced together separately so that you can achieve convenience, cost-effective solutions that help you reduce your tax bill. This webinar is for educational purposes, but we'll get into the nuts and bolts here soon. All right. So key deadlines and what you need to know. Tax season has already started and some of these deadlines have passed. So where are we at now? Almost at the end of February, which is crazy. We're in the thick of it. It's filing season. The IRS and all the states have opened up their filing systems. You should have received 1099s, W-2s, tax forms by the end of January. So the next deadline coming up, if you are already a small business owner with a partnership or an S Corp, that tax deadline is coming up March 17th to file or extend. After that is that April 15th deadline that everybody knows about to file your personal return. I'm just going to leave this here. We don't have to walk through every specific deadline. This is just the first quarter. Part of this partnership will be making sure that we pass through resources like this so that you're well aware to put these on your calendar. The tax season is here. It's live. Self-employed tax season tips. And so this is where I hope it's going to prompt a lot of great questions and conversation. Let's start with federal and state obligations. What's the difference? The federal tax deadline is determined by the IRS. So the IRS is the federal government. That could be very rudimentary, but those are connected. That's the tax form. It's called Form 1040, your individual tax filing. That's due every year, April 15th. All the Super Bowl commercials about H&R Block, TurboTax are all surrounding this April 15th deadline. The states usually piggyback or follow the federal deadlines. What's different is the tax forms that you might have to report on. So just something to be aware of. It kind of happens automatically if you self-prepare your tax return or if you have a CPA, they'll populate your state forms. Really, the purpose of this slide is to indicate that there is a difference. There's separation there. Sometimes the due dates will be different. If you extend your federal tax return, sometimes the state will have a different deadline. Failing to be aware of deadlines can result in underpayment penalties, late payment penalties, late filing penalties. So the TLDR of this slide is just be aware. Where you live can determine different tax deadlines. If you've got support or even something like TurboTax, it will almost always give you the deadlines or the due dates for your tax authority. Saving strategies for the self-employed. So this is going to be very high level, and I hope you've got some great questions to dive into the nitty-gritty of this. The best advice that anybody can ever give you in terms of lowering your tax bill is making sure that you can capture all your deductions. Maybe this starts with an awareness of what's considered an allowable deduction. The IRS says an expense needs to be considered ordinary and necessary for you to deduct it. So it's ordinary and necessary in the course of your business to generate revenue as a photographer, IT consultant, content creator. So the best advice anyone can give you is lower your business profit. That means capturing everything that you're eligible to deduct. Next, you can consider tax-deferred retirement plans. So I'm not a financial advisor. Sometimes this lingo is a little bit confusing for me. Tax-deferred is pre-tax. What that means is that in the year you contribute to this plan, you get a deduction or a write-off for that retirement contribution. Then when you're retired and you take that money out, that's when you pay the tax. And so these tax-deferred retirement plans can help you reduce your taxable income in the year that you contribute. For self-employed individuals, there's a couple different plans that apply depending on how you're structured. And so we can dive into the details of that later. Most of the time, we'll see folks who are solopreneurs set up with a SEP IRA. Usually this applies when you're set up as a sole proprietor or single-owned LLC, where you report your business activity on your personal tax return. The limits and how much you can contribute are a little bit different, but high level, both of these plan types are pre-tax. When a solopreneur switches to the S Corp election, we most often see a pivot to a solo 401k. The main difference between these two plans is who's eligible to contribute. With a SEP IRA, it's all considered employer contributions, which means there's one contributor. And that's a contribution that's limited based off of your net profit. With a solo 401k, you can contribute as both an employee and as an employer. So you are your own employee under an S Corp. You can make an employee contribution to solo 401k. The limit is adjusted every year by the IRS. I think this year it's 23,000. That is eligible to be made by you as an employee. And then your S Corp can make a matching contribution. I think it's up to 25% of whatever your salary is. And in total, I think you can contribute up to 69,000. So what's happening is you've got two ways to contribute, which means a higher contribution limit potentially, which means lowering your tax bill a bit more. So that's another strategy that works for people who like to set aside money for the future. Keeping accurate records. This does not necessarily mean you need a box of receipts. So you don't have to do that. That's very old school. And I have sat upon a box of receipts a couple times in my career in public accounting. You don't need to do that in this digital age. Pictures, bank statements showing the vendor are all perfectly fine. The main reason you want to keep accurate records is it gives you a perspective on where your business is at. Where can it spend money? Where are there opportunities? The contrary is having no visibility on what your profit is. How can you make decisions on when to spend? How can you make decisions on quarterly estimated tax payments? How much should you be paying into your tax bill? So maintaining clean records, maybe this is a separate business bank account, so you're not sorting through different bank statements. A bookkeeping tool is highly recommended because it's going to categorize and capture all these deductions for you automatically. So making business decisions and having eyes on where you can reinvest into your business. Now, once you've exhausted these options, you've done what you can to lower your profit. That's the best advice we can give you with between capturing deductions, considering retirement plans. What can you do next? Now you've reduced your profit. It is what it is. Now you got to pay into your tax bill. So something that happens very often when people are self-employed for the first time is that switch between being a regular employee and being self-employed. You don't have a way to pay into your tax bill when you switch to 1099 and self-employed. When you're a regular employee, you have withholdings taken out of every paycheck. It's a little bit depressing, but it helps you pay into your tax bill, which means you may get a refund or you don't owe as much when you file every April. What we see often with self-employed people, particularly when it's new, is they get to their first tax season. They think, oh, I have a spreadsheet. I did well. I got all these clients. I increased my bill rate. They're killing it. But the estimated tax payments were not on their radar. And so they get hit with this huge tax bill in April. And it's discouraging. And maybe a lot of you have been there. Where you thought you were killing it, you did everything right, you've proven your concept, and you get to filing a draft of your tax return and you owe 15, 20, 30, 40, however much money. Super discouraging. And so quarterly estimates are prepaying into that tax bill so you don't get sticker shock at year end. The risk in not doing so is that the IRS could assess penalties and interest. And what I personally think is the worst part is just fronting that cash up front to pay the tax bill. Maybell, you didn't know you had to pay estimates. You're not alone. A lot of people don't know. And it's not really a way to reduce your tax liability, but it is a way to lower the burden, the cash flow burden. And when all else has been considered and exhausted, you've written everything off, you're a service business, you work from home, there's not a lot of write-offs you can capture. What can you do next? Maybe it's considering your tax status. And so this is where Collective steps in. We're specifically built for solopreneurs who want to elect S Corp status. The short version of it is that it's an election layered on top of a legal structure. So for many of you, it could be a legal corporation, it could be an LLC. This S Corp election is added on top of that entity. And the short version is it helps you reduce how much you pay in self-employment tax. So if you're committed to growing your self-employed business, you've exhausted all the write-offs, your profits over a certain threshold, we use 60,000, then maybe it's time to reconsider your tax status. I see a lot of great questions in the chat. Bailey will be fielding these in the Q&A section, so I'm not intentionally ignoring. Let's see. And it's perfect timing. Went through that pretty quick, kept it super high level because I want to make sure we can tackle the questions that are most relevant to this group. So Bailey.
That was an awesome presentation. Thank you so much, Marissa. And woo, we have a lot of questions. So we'll have more than enough time to cover all of those. So why don't we go ahead and we'll dive right in. So first question we have came through quite a bit. What is the difference between an LLC and an S Corp?
Great question that we get all the time. So when you go to form a business, it's usually with your state. So you go to your state Secretary of State website, and that's where you do the initial business setup. What you're doing at that point is establishing a legal entity. This will be an LLC. The other alternative is called a legal corporation. And both of those are the legal structures established at the state level. It's what has your EIN attached to it. It's what establishes limited liability, so a separation of your business and personal assets. And so that's a legal structure. The S Corp is actually a tax election that gets layered on top of a legal structure. And so you're actually both. If somebody says, I'm an S Corp, they're going to have either an LLC or a legal corporation underneath as the foundation. And then the S Corp tax status is layered on top.
Awesome. I feel like that will help a ton of people because I saw that question come through about 4 or 5 times. So thank you so much, Marissa. So next question is, how would you recommend storing and sharing expense receipts for deductions with our tax advisor?
Yeah, so the cleanest way, and there's a lot of different ways to accomplish this, is using a bookkeeping software and connecting it to your business bank accounts and credit cards. What that'll do is set a baseline foundation for all your transactions to import into a bookkeeping software. It's going to pull in the vendor. It's got AI embedded into it. So it's going to know, like, if it's Home Depot or Office Depot, it's going to put it in office expense. So that's a great baseline way to categorize and maintain records. Keeping receipts, though, this is something that I kind of want to myth bust. There's this misconception, and it's super old school, that you need a receipt for every single thing. But now everything's digital. We can swipe a credit card, we can go on Amazon, and it can print you an itemized list. So the old school way of keeping receipts, maybe I don't think applies as much anymore. We really see receipts used when you've made a big purchase or there's a particular expense that could come into question. So an example of this might be you're a photographer and you bought this new, like, I don't know, steady glide cam or something. 5,000 bucks. It's a big purchase. You're investing in equipment for your business. So that's an instance where you might want to keep the receipt for that versus like your Amazon run for printer paper. We don't need a receipt for that. And an advisor really won't ask for it. Another example is when you are taking somebody out to lunch and maybe like you have a couple of drinks, maybe you go to a sports game. Those are the nature of those expenses could come into question more than others. And so keeping a receipt is so you can substantiate that there was a business purpose for the expense. So the purpose of receipts is to prove why you deducted something. So really, if you were to look at your expenses, which ones may come into question? Those are the ones that maybe keeping a physical receipt is more applicable to. Otherwise, like connecting your bank data so that it's only business bank account activity versus commingling personal, that's a very clean way to keep it simple.
That is great knowledge because I feel like so many people think that I have to hold on to my receipts and still have their file cabinet with all their receipts, So that's really good knowledge. So next question we have is, how would you go about setting up to pay quarterly?
So quarterly estimates can be done a couple of ways. They can be done very complicated or very simple.
Okay.
Coming from public accounting, I would see it both ways, and both are better than no payment at all. So I'll just start with that. Any payment is better than none.
Okay.
Really, what I think the biggest pain point with quarterly estimates, it's not so much the penalties and interest, it's the sticker shock of owing too much at once. And so this is why this concept of paying anything is better than nothing. What you want to do conceptually with quarterly estimates is try to estimate your annual taxable income. And what I mean by annual taxable income is, what's your business income? Does your partner work? Because we're trying to calculate tax based off of the individual household income. So you would compile your total estimated income, consider your write-offs, estimate where your taxable income might land to guess what your tax bill might be. Then high level, what you're doing is backing out, okay, what payments have I already made? My husband or wife has made withholdings, so I can back out those payments. And then what's left over is what you expect you might owe. That balance is split into 4 quarters, so 4 payments throughout the year. And that's the short version of how you determine quarterly estimated taxes. So one, it's determining your taxable income so that you can guess your tax bill. Back out how much you've already paid so far, if any. And what's left over, you should pay in 4 times throughout the year. The way you actually pay them is super easy. Online, IRS web pay, state web pay, and you just follow the prompts to submit a payment.
Awesome. So next question is from someone that's a new business owner, and she is going to be filing her taxes for the first time. And she asks, what are the top tax deductions that small business owners miss out on frequently?
Ooh, if you're a remote worker, you have a home office deduction. So this is getting to deduct a portion of your rent or mortgage, utility bill, internet. If you're self-preparing or you've got an accountant helping you, we've also got some blogs and resources we can send out on how to do that. But the home office deduction, especially now when everybody's working from home or it's service-based, that's a big opportunity. Top deductions people miss out on. Mileage. If you drive, you can deduct a portion of your car. So we see this a lot with real estate agents. They spend most of their time in their car. There are a couple of different ways to deduct your vehicle, but considering what you do, is mileage an appropriate expense? Continuing education is one that's actually come up a lot. Are you attending webinars that cost money? Are you doing certifications on LinkedIn Learning and you're paying for it? Anything that's helping you develop so that you can serve your clients or grow your business is a write-off. Let me think of one more. Is there one more? Marketing and advertising. So how do you sell yourself? Is it attending happy hours? Is it Facebook ads? I think that's pretty on the nose, but that's something that comes up often.
Follow up with that question. Are there any? Oh, go ahead.
Send it out.
2 follow-ups to that, because we had a lot of questions about this. Are there any rules when it comes to writing off your home office?
Yes. The IRS has a lot of rules that don't make sense sometimes. There are a lot of strict stipulations with claiming a home office deduction. One of them is it needs to be your principal place of business. So if you have an office that you go to, technically you can't also claim a home office deduction. You allocate a percentage of your home. So really it's like taking a square footage of this space divided by the total square footage of your home. And that percentage is applied to the eligible deductions. The risk there is maybe claiming too much. Some people say, well, I work throughout my whole house, or sometimes I work on the kitchen table. There could be risk in claiming too high of a percentage for the home office deduction. So I think finding something that's reasonable. You can't deduct your entire rent, but you can deduct a portion of it. Most people end up floating around 20% for the home office deduction. So is it
Okay.
your primary place of business, and then not over deducting?
That's good to know. And then this question came up a lot too, so I'm just going to paraphrase it. Is there a specific amount of revenue you have to bring in as a business owner to have to file your taxes as your own business owner?
So the correct answer is that any income you receive, whether it's reported on a 1099 or it's a cash payment, is taxable income. There could be a point at which if you make below a certain amount, you won't have a tax liability, but you still want to report it.
Okay.
There's no minimum, there's no maximum, but if you're receiving cash payments, all of it should be included on your tax return.
That's good to know. And last follow-up on what you just said for a car, can you write off a car purchase?
So the way this is going to get very taxy, so I hope you're ready. Um, one is determining what's the business use percentage of this vehicle. So it's going to depend on your industry. If you are, I don't know, a moving truck company where the vehicle is primarily used for the nature of this business, the way that you deduct a vehicle, it's called depreciation. The concept is that instead of writing off that total cost in 1 year, you depreciate it, meaning you take the deduction over a period of time. That period of time is determined by the IRS for the type of thing that you purchased. And so for a car, it's 5 years. It would most likely be depreciated. Then you consider what's the business use percentage. And so similar to home office, you would apply a business use percentage if it's not 100%. And then that depreciation is what would become deductible.
Got it. Awesome. So let's move on from this slew of questions. A lot of people are asking about what exactly collective does. So I'm hoping you could better define. For example, someone asked, I'm sure I can find this on the website, but does collective assign a team or a specific person to each account for, let's say, bookkeeping services? So maybe just explain what collective does.
Yes, I'm sorry I didn't dive into that. I was so focused on the tax side. So collective, again, specific for solopreneurs who want to elect S Corp tax status. And so to reiterate, the benefit of the S Corp election is that it helps you control and reduce the self-employment tax burden. The downside of making this election is the administrative burden goes up greatly. If you're structured as a sole proprietor or single-owned LLC, your tax reporting is very simple. Like everything goes on your personal tax return on that Schedule C. An Excel spreadsheet is doable for your tax reporting. You don't need payroll. You don't need to file a separate tax return. So when you make this election, it triggers all this additional work that you wouldn't otherwise have to do. When you elect S Corp status, it triggers a need for more comprehensive bookkeeping. So you need to report a profit and loss statement and a balance sheet. Those financial statements get reported on a separate business tax return that would now be due. And lastly, this is, in my opinion, the most complicated piece is you have to pay yourself a reasonable salary. And this is running a wage through a formal payroll software. So now you've elected into this tax status that helps you reduce your tax bill, but you've also signed up for a lot more compliance. And the risk of not staying compliant can mean penalties, revoking your S election, not being eligible to reduce your self-employment tax anymore. And so the idea behind Collective is that we will bundle together all of those services for you under one login, one fee, one dashboard, so that if the S Corp election is the right path for you, we can tackle all that administrative work under one roof.
Awesome. Very cool. Sounds very helpful and needed. So next question we have is about 1099 contractors. Do I need to file a 1099 for every contractor that I work with?
So this limit may be changing with the IRS, but the rule has been if you pay any one individual over $600 throughout the course of a year, that's what triggers the 1099 filing requirement. It's under you technically don't need to give them a 1099. That individual still has to report that as income. They're just not getting a matching tax form.
Okay. And a follow-up to that, this came through a few times. How do I file if that client cannot give me a 1099? Perhaps they're overseas or they're unable to provide one.
So on either end, so if you are the recipient of a 1099, you should be a recipient of a 1099 that you didn't receive. This is where keeping clean financial records can come into play. That income still hit your business bank account. So whether you receive a 1099 or not, you should include it. If the IRS doesn't have a 1099 on file, all that means is they're not matching activity from who gave it to you to your personal return. But still, based on your records, that's revenue. On the flip side, if you're the one who needs to give out a 1099, you're not technically an employer, but as the person paying somebody, you're obligated to submit that 1099 to both the IRS and the recipient. That deadline is January 31st of every year. So it's both ways. If you need to issue, it's your obligation as a business owner to make sure that you know who needs one and issue it timely. And the flip side, if you did not receive one and you thought you needed to, it's still your obligation to report that income.
Okay. Another question that came through about 5 times, what bookkeeping software do you recommend?
Well, if you're a good fit for collective accounting, that's included in the membership, and we do all your monthly bookkeeping for you. If you're a sole proprietor, so maybe S Corp's not the right fit for you yet, I think we've heard a lot of people talk about Wave. It has a free option. It's great for very simple profit and loss tracking. There's tried and true softwares like QuickBooks Online, Xero, where you would probably need to pair that with a bookkeeper if you're not experienced with doing your own books. But if S Corp's a good fit for you, Collective's got you covered.
And I did want to mention, if you are a Novo customer, you can use the link in the chat for 50% off your first 3 months with Collective. So if you're interested in trying it out. And someone just said Wave is great. And they also do integrate with Novo. So that's another option. So another question that's come through quite a bit is, what is the best way to keep track of cash payments in your opinion?
Having a business bank account will make this much easier. You deposit the cash so that it hits the bank account, so that deposit can feed into your bookkeeping software, and then it'll be coded as revenue.
That makes sense. Another question, and I know someone asked this a few times in the chat. So can you please explain the sales tax nexus?
Whoever asked this question, I'm sorry, I'm going to disappoint you. I don't know much about sales tax. It greatly depends on your locality. So maybe it's a county or a city issue. And I think the nexus will be determined based on locality. Sales tax is usually, it's not something that Collective does because it's so nuanced and determined at county level. And it's not really tied to income tax filing, which is what we focus on. Admittedly, I have not touched sales tax. I'm sorry, I don't know.
No worries, you know a lot, so we can only ask you so much, Marissa. Next question we have is it true that Venmo and PayPal payments are taxed now?
Technically, they should have always been taxed. As the business owner, it's your responsibility to capture that income as revenue. What's changing now with this whole movement of digital payment options is these companies are now required to report some of that on new tax forms. So I think it would be the 1099-K that gets generated out of these payment platforms. And that's so that the IRS has visibility on business income that's earned. But technically, it's always taxable.
That makes sense. Next question is, can I claim business expenses from earlier in the year if I forgot?
Yes, so you can write off expenses that happened within the confines of the tax year. The only different, well, this is going to be very nerdy. There's a couple different methods of accounting. Most people that are small business owners will fall under this accounting profile called cash basis accounting. All that means is you capture deductions when they happen. And so the cutoff is usually when the tax year ends. So anything that happened between January 1 and 12/31 is eligible for a deduction.
Good to know. So next question we have is, what happens if I never filed taxes for my old LLC that never made money?
If it was just an LLC, well, it depends on who owned it. If it was a single owned LLC, what that means is it was considered a disregarded entity. So for federal tax purposes, it means you and the business were one and the same. So there was no federal tax form for that LLC. Depending on where you live and where that LLC originated, there may be LLC annual filings and forms that would have been required even if it was no activity. So I would check which state. I know I'm in California. There's a California LLC form that's due every year. So it depends on where your state is. There would be a fee and a filing. If you're not using it, I would recommend dissolving it to
Okay.
stop new fees from being incurred.
That's good to know. And Marissa, if you could go to the next slide, it might help some people if they are interested in giving Collective a try using the Novo code. So figured I'd just have you move over to that one. So next question we have is, let's see. Oh goodness, we have so many that have come through. How do I file taxes? Or actually, let's do this one. Can I carry over a net operating loss to reduce my taxes next year?
Yes, as long as you properly reported the loss in the year that it happened, it carries over. Now, some states have revoked their carry forward rules, or there may be some limitations, but generally NOLs are eligible to be carried forward.
Okay, that's good to know. Next question is, can I really get away with not filing taxes my first year in business?
You should never try to get away with not filing taxes. Even if you didn't make that much, maybe you had startup costs, and maybe that is going to generate a loss that you can carry forward to a year that you start earning income. Another instance where you may want to file regardless is if you had withholdings or you made quarterly estimates, but you ended up with no taxable income. Filing will give you that money back. So I always recommend filing to get some money back and just not risk a notice.
Makes sense. So next question we have is, let's see. I have a single member LLC. When should I consider switching to an S Corp?
So this is something we can discuss on a follow-up call, but I'm going to keep it super high level. When that business profit, so what you bill your clients minus the expenses, is the profit. When that profit is over 60,000, or you expect it to be over 60,000, that's the point at which it makes sense to have conversations about adding the S Corp status.
That makes sense too. So we are coming to the end of our time here, and that's not to say your question won't be answered, because we do have a few different locations in which we could have our follow-up questions answered. So what we wanted to do was just take a moment to close out today's session and thank everyone so much for attending. A big shout out to Marissa for sharing her experience, and to Collective with partnering for Novo to bring this valuable content to our community. We love collaborating with like-minded companies and truly understand the challenges self-employed entrepreneurs face. So thank you all for attending, and we are excited to host more events like this in the future. As Michael had mentioned, Novo hosts events like this weekly. We have what we call creator subject matter experts, as well as a variety of different partners that are helping to host educational events on different topics to help you better learn and grow as a business owner. What I'm going to do is post a link in the chat to 2 communities that Novo has to offer, as well as a form to sign up to opt in for future community and event updates. I highly suggest that you opt in for those community and event updates, because we will have a special announcement in the near future, creating a community of ourselves. So please go ahead and input that there. Stay tuned for future content. And if you missed anything from today, that's not to worry. We're going to be sending a follow-up email with the recording, a link to the PDF document, and that will also include this QR code and link if you are interested in utilizing Collective to try it for 50% off for your first 3 months. So thank you so much for joining our Novo brand event series. We loved having you here, and thank you, Marissa, and we'll see everyone at the next one.
Thanks, everyone. Take care.